After Luna and UST went bust, the crypto bubble burst. Several exchanges were found swimming naked, and exchanges like FTX, BlockFi, Celsius, and Voyager, and several other exchanges went belly up. And this initiated the phase of the perp dex movement, where we had several different dexes do extremely well. And one of them in particular was GMX, and it actually ended up outperforming the market. But in my opinion, the market has become saturated. Just because GMX was one of the top performers in the market, and you can see here it actually outperformed Bitcoin, and they even have a category of forks on DeFi Llama that says, hey, look, these are different GMX forks. And you even have a specific category for the derivative protocols. There are so many out there. The market has become so saturated with these perp dexes, most of the price charts look like this now. People have already taken profits, they moved out, with a couple of exceptions that actually outperformed on the markets. Some of those exceptions are like GMX and Gains Network. I see this as DeFi 1.0, but for the perp dexes. In my opinion, we are going to see a shift in the DeFi 2.0 phase for these perp dexes to where we have a protocol that operates as the layer 0. And that layer 0, in my opinion, is synthetix. Synthetix has been around for a pretty long time. In fact, it was actually one of the kickstarts for the DeFi summer we had back in 2020. And at its peak, it went to around $25. Currently, it's trading at only $2.83, and you're probably looking at the chart and you're like, man, this is a dead coin. But with some of the recent updates from V2 moving into V3 on synthetix, it has me extremely bullish on the protocol. But to better understand why synthetix is potentially going to disrupt the perp dex space as the layer 0 for these dexes is because it's creating the rails for anyone to build upon. The difference between using something like synthetix over GMX is that on synthetix, people can stake SNX or they can lend out ETH, DAI, and even LUSD to issue or receive the SUSD stablecoin. This module is on synthetix. You can actually go directly to the staking app and see what this looks like. As you can see here, if you lend out some ETH, you can actually borrow at a 120% collateral ratio with the SUSD stablecoin. And also, if users want to stake SNX, they can stake some SNX currently at a 500% collateral ratio and receive SUSD. This SUSD that is created is then the fuel for the market to use for the derivative space. Quinta is one of these proof of concepts for synthetix and using the SUSD infrastructure. When a user wants to trade on Quinta, all they need is the SUSD stablecoin, and they can trade between several different assets. Cosmos, Avalanche, Gold, Silver, Solana, GMX, Aave, several different tokens are listed on Quinta as an exchange. Now, Quinta is only one of the proof of concepts for the synthetix ecosystem. This SUSD that is minted directly through the synthetix module is the backbone of the derivative space that is built on synthetix. This can be used to mint several different synthetic assets ranging from the euro, gold, silver, the yen, and several other crypto assets. Having SUSD as this backbone theoretically creates infinite liquidity and near zero slippage via atomic swaps because these assets can be interchanged with each other. Almost like a omni pool. On the other hand, using a perp protocol like GMX, they also offer zero slippage because they use chain link price feeds, but they did have an exploit in the past due to that from someone manipulating the oracles. But if you take a look at the different pairs on GMX, you're just limited to what's deposited into that GLP pool, which in this case, you can trade ETH, Bitcoin, Link, and Uni. And this is on the Arbitrum network. So on Avalanche, you can also trade the AVAX token. So you can already see the major difference between something like GMX and Quinta with the different token pairs. In theory, other protocols, if they wanted to, they can build on top of the GMX tech stack by using the GLP token, but here's the problem. If a user or a protocol is using the GLP token in their ecosystem and they end up being a perp dex similar to GMX, one, they are limited to the token pairs that are in the GLP pool. Two, they now have to compete directly with GMX. So even though they're using GLP, how are they going to garner some users over to their protocol in exchange for simply just using something like GMX? The TLDR is, well, it's not going to be as easy to compete with GMX using GLP. One, you don't have as many options. Two, the fees are extremely high. GMX has some of the highest in the perp dex space. And three, you're limited to the assets in the GLP pool. Whereas with synthetics, you can create as many synthetic assets that you want using the SUSD stablecoin. And here are a list of a couple of different protocols that are leveraging SUSD in the synthetics ecosystem, all driving fees and revenue back to SNX stakers, aka the layer 0 for all of these perp dexes and the derivative space. So Quinta, Polynomial, Lyra Finance, DHedge, all of the volumes that they drive go back to the synthetics stakers. And if you take a look at the chart on DeFi Llama and initiate the fees and revenue, you'll actually see what I mean. As they recently integrated several of these different protocols, you can see here that their fees and revenue spiked up. So aka real yield. And as you can see here, there is a newer spike starting in March 5th. And you're probably like, man, why is that? Well, this is actually the inception, or when Quinta started picking up massive amounts of volume. As you can see here on Quinta, around March 5th, actually, I guess you can call it March 7th, March 10th, and then it started picking up going through here. You can see Quinta has been garnering a lot of volume. In fact, a total of over $19 billion in trading volume. All of this volume and all of these fees go directly back to the people who are staking SNX. So if you go over to the staking app on Synthetics, people can stake their SNX and they can earn a fee in SUSD as well as SNX rewards. And currently the APR is 21%. This is on Optimism. If you're on Ethereum, it's actually a little bit more, and that's due to atomic swaps. If you want to understand atomic swaps, that's for another video. I actually made one previously. You guys can check it out. But the TLDR of what I want you guys to understand is Synthetics is acting as the picks and the shovels, not as the gold miner. Let me explain this. GMX is the brand asset. Quinta is the brand asset. Level Finance is the brand asset. As I showed you guys the charts in the beginning of this video, some of them have completely died off. Like Mummy Finance, since the multi-chain hack, it was trading at 10 cents or $10 a token. It's now trading around 50 cents. Then you have other protocols that are just completely dead because their token is printed to an oblivion. They were kicking the can down the road by incentivizing LPs and incentivizing people to stake by emitting their token. Eventually, you have to pay for that. But Synthetics provides this solution so other people can use the SUSD stablecoin and not Bootstrap liquidity. I'll explain more on that in the video later, but again, I want to reiterate, GMX success depends on GLP and the success and how they're able to bootstrap the protocol. Whereas with Synthetics, if Quinta does well, awesome. It brings more revenue back to Synthetics. If Lyra Finance, which is also built on Synthetics, does well, great. It brings back revenue to Synthetics. Anyone can build on Synthetics, and the revenue is driven back to SNX stakers. If any of those go bust, it is just a revenue stream that goes down, and anyone else can build on top of it. Whereas with GMX, if GMX goes bust, GLP goes bust, GMX is roasted. There's no reason to stake GMX. The reason why people are staking GMX is because people are trading on that DEX and generating trading fees. So DeFi or perp dex 1.0 would be your Level Finance, Gains Network, Quinta, GMX. Your DeFi 2.0 or DeFi perp dex 2.0 would be like Synthetics. This is the layer 0. Other protocols can literally build on top of Synthetics. So now you're probably thinking, well, this is cool for Synthetics, but why would a protocol be incentivized and inclined to say use the SUSD stablecoin instead of starting and initiating their own protocol and bootstrapping their own liquidity? Well, it has to do with this thing we call money. It costs a lot of money to bootstrap on GMX, for example, to bootstrap GLP, as well as get people to stake GMX. I want to show you guys a couple of the earning ratios as well as the earning dashboard so you guys can see this. Currently, if you stake GMX, you're literally going to earn 2% APR, paid in ETH. That's weak sauce, dude. Like, you're having exposure to GMX and you're earning 2% paid in ETH. This used to be much higher in the early days of GMX. The same thing goes for GLP. This was actually bootstrapped and incentivized with additional locked and escrowed GMX token. But now they're starting to pay for it as some of those unlocks are hitting the market. But if you take a look at this APR, it's around 7.5%. I mean, dude, to get this 7.5%, you have to have exposure to Uniswap, Chainlink, USDC, and some stable coins, and you have exposure to Bitcoin and ETH. Now, sure, I like Link, I like Bitcoin, I like ETH, and maybe holding some exposure to the stable coins, but that 7.5% sure don't pay the risk for having one of those stable coins getting depegged. Or that doesn't pay for the risk that if some of these traders are profitable, I lose money. Like, I'm being paid in this position because I'm taking on that risk. If traders win, I lose. And yes, there are ways to hedge this position, but in my opinion, being paid 7.5% in ETH is not enough for me. And this is why a protocol would be incentivized to using something like SNX in the synthetix ecosystem. They don't have to pay to bootstrap liquidity. And I mean, if they do have a token, that's the only thing they would have to pay for in order to get people to stake their token. Quinta has done that, and they were able to get a grant from Optimism, so they're incentivizing through escrowed Quinta tokens as well as OP tokens. They don't have to pay for liquidity for a KLP pool or whatever you want to call it. They're leveraging people already opening up active debt positions on synthetix by staking SNX or lending out ETH. So you can kind of look at synthetix like the GLP pool, but it's not. It's not GLP. People are staking over here SNX, ETH, or any of the other collaterals that are accepted, and they're earning this 33%. They can actually hedge their debt using dehedge. So in theory, as long as they're managing their liquidation points, this could technically be a 33% risk-free yield. Now, it's not without risk. There is such thing as liquidation, but I'm just throwing it out there. I made some previous videos on that as well to explain how to hedge your debt. So with just Quinta as the proof of concept, you can see here that the revenues for synthetix are spiking. But there is a catalyst coming up that was announced, and it's called Infinix. Now, Infinix is a decentralized exchange being built using the synthetix tech stack. Infinix is aiming for the middle user. It's not aiming for that DeFi degen who's already got 80 different wallets and knows how to bridge on any chain that they want in a given second. And it's not aiming for the dude who's like, I just want to deposit it into an exchange. If I lose my password, I want to be able to log in. If that exchange goes bust, who cares? They're aiming for that middleman who's like, man, I should really take custody of my assets, but it's too complicated to have 40 different wallets or 80 different wallets. That's the audience that Infinix is aiming for. So Infinix will have two different interfaces. The first is like a simple mode for traders. This will be like Uniswap, but with leverage. And then you'll have a pro mode, and this is going to be for like experienced users. The protocol or the exchange will generate revenue with several different mechanisms, with the likes of trading fees as well as LPing the SNX. Now, this is where the sauce comes into play for synthetix. All of the revenue generated on that platform goes back to accumulate additional synthetix tokens, which is then used to deposit into the LP and then get more rewards and rinse and repeat, eventually trying to become the largest LP in the synthetix ecosystem. So launching this DEX not only drives revenue back to SNX stakers because of the fees and volumes driven around the SUSD stablecoin, but it's also going to buy the SNX token, LP it, and continue to do so, compounding those LP fees. Again, I see synthetix and the SUSD stablecoin as the layer 0 for the perp dexes and the derivative ecosystem. Rather than being exclusive, synthetix is being inclusive of all these other protocols. It's not trying to change the perp dex space. It's not trying to be the next GNS. It's not trying to be the next Quinta. It's not trying to be the next GMX. It's literally providing the infrastructure for anyone to deploy their own dApp, with that revenue being given back to the users. That's also one other incentive for people to develop their own protocols on top of synthetix. There's a thing called revenue share. Quinta currently got a proposal passed to where they're actually getting a rebate of 5% of their protocol revenues paid in the SNX token. So in summary, the bet on synthetix is like investing in the company that sells the picks and shovels instead of the companies that are going out there and mining the gold. Yes, there are going to be some of those protocols that outperform in the market and just kill it like GMX, but in my opinion, those days are behind us. And yes, there will be another one that launches out, but picking that is like picking out a needle in the haystack. I would rather invest in the infrastructure. Another example of this is Ethereum. Nobody knows what the next big protocol is going to be. It just shows up as it goes into the bull run and it just starts killing it. Or you can just have exposure to ETH and get exposure to that upside. So just a couple of things to keep in mind. Now, if I told you synthetix was without risk, I'd be lying to you. There is risk involved with this play. First, obviously, if Bitcoin and ETH nuke, there is the potential for obviously trading volumes to basically go to zero, and there is really no reason to even have a perp dex or people to be able to speculate and trade on different crypto assets. Two is another competitor shows up with a better picks and shovel solution. In my opinion, synthetix has been around for a long time, and it's been working on this issue for a very long time. It is well interconnected into the DeFi space, and it is partnered with several different protocols, and it has a pretty strong head start. Obviously, time will tell, and we'll see what will happen. Third, you also run into the risk of the collateral of the SUSD stablecoin being, well, having bad debt. And in my opinion, its collateral ratios are pretty healthy, with the SNX token over 500% and ETH as low as 120%. Yes, there's a chance for a cascading liquidation event, but there are other collaterals backing the SUSD stablecoin. And then, of course, there is the other factor, is that its trading fees are not competitive. Well, actually, GMX has some of the highest fees in the space, whereas synthetix has some of the lowest trading fees in the space. Now, is that enough to compensate users? That could also be another risk as well. The people having a position on synthetix and opening up that bad debt, is it worth them to stake and earn those rewards? And if traders are profitable, their liquidity is drained. As always, time will tell. This is not a risk-free trade, but just looking at the charts, I do like the risk to reward. I'm not saying it's going to revisit these prices, but with a couple of catalysts and the recent strength in its revenues with the proof of concept with Quinta, I do see a bright future for synthetix. This is just one of those plays that I'm bullish on, that I see as the layer 0 for the perp dex space. I prefer to invest in the picks and shovels over the gold miners. That is the case for synthetix and how I see it as the layer 0 for the derivatives and the perp dex ecosystem. If you guys enjoyed this video, make sure you guys drop a like, subscribe to the channel, and if you guys want to join the exclusive Discord, there's a link in the description below. I share a couple of different projects I'm interested in that I don't show on YouTube, as well as a couple of videos that I don't show on YouTube. You can also chat with a bunch of other DeFi degens there as well. And if you want to see some of the previous videos, y'all know what to do. It's the previous videos. You just go check them out. As always, guys, let's go ahead and hit you guys with a wisdom one-liner. We're in Proverbs chapter 12, verses 1. I love this one. Whoever loves discipline loves knowledge, but whoever hates correction is, well, stupid. Guys, love discipline, love knowledge, be good, be righteous. Peace.